Professor Karn here to help you go through the accounting cycle. In this demonstration, we will go through steps 1 and 2 of the accounting cycle. Just a reminder, you can find this Excel document in document sharing. Okay, so let's take a look at this. Basically, we're going to go through steps 1 and 2, analyze source documents to determine if a transaction has taken place. And if yes, we'll go to step 2. If no, we'll stop. In step 2, if we get to that point for the transaction that we have to record, we record it in the general journal. Alright, in this problem, which we'll be building throughout the course, this is the chart of accounts that we will use. In this step, we will use some of them, but not all of them. And as we go through this exercise, here are some questions again to ask yourself. Has anything come into the business? Has anything left the business? Those are two key crucial questions to help you really record journal entries. We have our rules for debits and credits. Again, AWE, assets, withdrawals, expenses, debit plus, credit minus. And then CLR, capital, liabilities, and revenue are always debit minus and credit plus. Now, that doesn't mean that we can't debit or credit them at any time. In any case, again, we can debit or credit any account. The only thing that we have to remember here is that we can never have an abnormal balance, and we'll see how that plays out in the next video in step 3 when we post our journal entries into the T accounts. Okay, so again, our rules for double entry accounting or recording transactions in a journal. We can debit or credit any account. You must always have at least one debit and at least one credit in every journal entry. And the total amount of the debits must always equal the total amount of the credits in every journal entry. Again, for those past 2 rules, no exceptions under any circumstance to those. And again, compound entries are allowed as long as you do not violate the rules above. And in this illustration, we will see, I believe, 2 compound entries. All right, how do we format our journal entries? Okay, the first thing we have to do is we have to enter the year on the top line of the date column. And you'll only need to do this once on the page. If you turn the page in your journal, then you would actually write the date, the year again on the first date column line. When you get presented a transaction, you'll enter the date of your transaction. You'll record all of your debits first. Each account that is debited must always be flush against the date column line. After you've done all of your debits, you record all of your credits, and you must indent all of your credits recorded in the journal. You have to ensure that the total amount of the debits equals the total amount of the credits, and then once you're done, skip a line before you do the next journal entry. Okay, so let's look at this comprehensive problem that we will be building throughout the course. I have put the data here for us. It says on December 1st, Kurt Walton began an auto repair shop. Walton's Quality Automotive. The following transactions occurred during December, and it gives us a whole slew of transactions, and we have to determine if a transaction's occurred, and if so, we have to record that transaction in the journal. Okay, so let's go ahead here. We'll use 2016 as the year, so let's go ahead and put that in our date column there. Oops, 2016. Okay, and so let's go ahead here and look at the first one. It says here, Walton contributed $55,000 of cash to the business in exchange for capital. Okay, so again, let's go to the questions to ask yourself. Has anything come in to the business? Has anything left the business? Well, yes, something has come in. Its cash has come in, and the owner has made an investment and gotten capital for it. Okay, so we know we're going to put the date here as 12/1. And let's go ahead here. Let's think about this. Cash has come in, that's an asset. So if we want to increase an asset, we will debit it. So we'll debit our cash. That was for $55,000. And then the owner made an investment. Anytime the owner makes an investment into his or her business, you will always credit and increase the owner's capital account. So we will indent our credit here. We'll put Walton Capital. $55,000. All right, we're done that journal entry. We have one debit, we have one credit, and the total amount of the debits equal the total amount of the credits. So we're good in good form there. Okay, so let's see what we have next. Again, we have another 12/1 transaction date. Let's see what happens on the second one. It says we purchased $9,000 of equipment paying cash. So again, has anything come into the business? The answer would be equipment. Has anything left the business? The answer would be yes, we gave them cash. So basically we traded one asset, cash, in exchange to get another, equipment. Okay, so let's go ahead and debit equipment because that's what's coming in. I'm going to go up, it's an asset, and that was for $9,000. And we gave them cash, that's an asset, it's going to decrease, and we decrease assets by crediting them. So we will credit cash, 9,000. Okay, again, one debit, one credit, and the total amount of the debits equals the total amount of the credits. We have another transaction on the first. So the third transaction was we paid $1,500 for a 5-month insurance policy starting on December 1st. Okay, so let's think about this for a moment. Obviously, anytime it says we paid anything, cash is going to be leaving the business. But in this case, what's coming in? Is anything coming in? So we're purchasing insurance in advance, not just for this month. So we'd have to use an asset that you probably haven't seen before, and it's called prepaid insurance. So we will debit that. Again, that's an asset account. And prepaid insurance is a prepaid expense that we will have available to us, in this case, for the next 5 months. So we debit that for $1,500, and we credit cash for $1,500. Again, one asset is coming in, prepaid insurance, and one asset is leaving the business, in this case cash. Just so you're aware, as each month passes, we will have to recognize how much of the prepaid insurance has been used up or consumed, and that's when we get to step 5 of the accounting cycle. So we record it right now as an asset, and we'll recognize it, how much really we had as an expense in the month at the end of the accounting period in step 5 of the process. Okay, we skip a line here, go to the next journal entry, and it looks like we have the 9th of December. And the 9th of December, it says that we paid $16,000 of cash to purchase land to be used in operations. Again, it looks like we are giving up cash to acquire another asset, in this case land. So again, we will put the date here. This is the 9th, 12/9. We will debit land in the amount of $16,000, and we will credit and reduce our cash because we are giving that up to acquire the land. Again, we can debit or credit any account. We just know that once we get to the next step, which is step 3 of the accounting cycle, when we post these transactions to our general ledger T accounts, we can't have any abnormal balances. So we'll see how that plays out when we get to that step in the next video. Alright, so let's see what we have next. On the 10th, we purchased office supplies on account for $2,000. Okay, here's a bit of a teaching moment. What we want to realize here is that obviously we're buying supplies, and office supplies would be an asset, so we know they're coming in. So let's go ahead and let's get that out of the way. We know it's the 10th. So we know we're debiting office supplies because that's an asset and they're increasing. And we debit office supplies in the amount of $2,000. Okay, now, one thing you probably want to make note of here is anytime you see it tell you in a transaction that you bought something on account, or you could even say if you bought it on credit, then that's going to refer to something that we owe. In this case, we owe either a business, which could be a vendor, or we owe a person, and that could be referring to something you could have bought someone from privately. In this case, we probably just bought this from a very simple business and we owe them the money. So anytime we owe someone money, in this case on account or on credit, it's going to be referred to as accounts payable. Accounts payable is a liability, again something we owe, and it's going to have a credit balance, and that's why when you think of capital, liabilities, and revenues, we know that accounts payable is a liability and will increase by crediting that account. All right, moving to the next one on the 19th. We borrowed $12,000 from the bank for business use. Walton signed a notes payable to the bank in the name of the business. The note is due in 5 years. Okay, in most cases, your textbook will always tell you if there's a situation where you're signing a notes payable. So in this case, you're borrowing money from the bank. You owe the bank the money. In this case, they didn't really specify, but you're probably also going to, over the time of the loan, going to have to pay interest expense in addition to paying back the $12,000. So we don't need to be concerned about interest expense today, but later on you will see how you may have to record the amount of interest expense that you had on the note. Again, notes payable would be a liability account separate from accounts payable. So here we're going to debit. We know what's coming in. We borrowed $12,000 of cash. And we will credit our liability account, notes payable. Okay, again, you will pretty much use notes payable. They would specifically tell you that in the transaction. But if you see just borrowed something and it doesn't say anything about a notes payable, just use accounts payable. All right, on to the next one. That is the 22nd. We paid $17,000 for advertising expenses, so we paid them, so we know cash is leaving the business. And obviously we will have numerous expenses in this case. Anytime you have an expense that you have to record, expenses are part of assets, withdrawals, and expenses, which have debit balances. So we would have to debit advertising expense. And in this case, we had a $1,700 advertising expense bill, and we paid that, so we're going to credit cash. Basically, in this case, we paid off a bill as far as an invoice or something we received from someone else. We had advertising expense, expenses going up, and cash is exiting the business. Okay, on to the next one. In this case, that's the 26th. We paid $300 on account. Again, anytime we pay something, cash is going to be exiting the business, so we know we have to credit that, but what do we have to debit? In this particular case, when we pay on our account, it means that we're reducing the amount that we owe. Obviously, we know that we've had several things that we bought on account. We had this here, and we also had notes payable. But in this case, because it tells us we paid on account, that means we're going to reduce the amount of our accounts payable. We do that by debiting it. So we debit accounts payable. For $300. And again, what are we going to give them? We're paying it, so we know we're going to credit cash for the same amount. Our liabilities decreased and our assets decreased. We go to the next one, the 28th. The 28th says, the business received a bill for utilities to be paid in January for $180. Now, oftentimes students misunderstand this as, oh, well, there's not a transaction in this case. Well, there is, because we've incurred this expense for utilities. Now, it doesn't matter when we're going to pay for it. Okay, so we have to record that expense in this accounting period. And we owe it. We're not going to pay it till later. So let's see how this is going to work. So we know our expenses have to go up. So we're going to debit utilities expense. And that was for $180. And we know that we owe that, so we're going to credit accounts payable because we're not going to pay for it until January. No cash is leaving because we have not paid it yet. Our expenses increased and our liabilities increased. Okay, then we have 4 different transactions that we have to do on the 31st of the month. So our first one takes us to revenues earned during the month included $14,000 of cash and $2,600 on account. Okay, this will be the first of our 2 compound entries that we'll be able to address here in this illustration. So we know cash was earned in the amount of $14,000, so we know that's going to come into the business. And notice it tells us that we also earned $2,600 on account. Now, what does that mean? Well, that means that we extended credit to our customers that would allow them to pay us at a later time. So they owe us the money. All right, let's do the easy thing first. Anytime cash comes in, we know we have to debit that. So cash in the amount of $14,000. And we go back up and we look again. We know that $2,600 was owed, well, is owed to us on account by our customers. So anytime that is the case, that is referred to as accounts receivable. So that is an asset, and we will debit that because it's increasing. They owe us the money. It doesn't mean that they're going to pay us. It just means they owe us the money. So hopefully we will definitely get the cash, but it's not a guarantee. Now, right now, as this journal entry stands, we only have 2 debits. So obviously this is not a journal entry in good form. This would be violating our rules. We do not have anything that's being credited. Well, in this case, they referred to this particular transaction as revenue that we earned. Anytime we earn revenue, we know that we will credit and increase the service revenue account. So in this case, we would take the $14,000 and we'd add the $2,000, the $2,600, and we get $16,600 as our total amount of service revenue that we earned during the period. So obviously we had, in this case, a compound entry. We had 2 debits and 1 credit, and the total amount of the debits equals the total amount of the credits. So this is now a journal entry that is in compliance with our rules. Let's go to the second entry on the 31st of December. And it tells us here that we paid employees salaries of $3,800 and building rent of $1,300. They specifically in this case tell us to record as a compound entry. Okay, so let's think about what these would be. Salaries and rent, both of those would be expenses that we've incurred in this accounting period, and we need to recognize both of those. Remember, we increase expenses by debiting them, so we will debit salaries expense, in the amount of $3,800. We will also have to debit rent expense in the amount of $1,300. And again, it told us that we paid these expenses, and anytime we pay anything, remember cash is exiting the business, so we will credit cash for the total amount of $5,100. The total amount of both salaries of $38 plus $1,300 of rent expense for $5,100. Again, 2 debits, 1 credit, and the total amount of the debits equals the total amount of the credits. The third transaction on the 31st of December is the business received $1,400 for auto screening services to be performed next month. Okay, so let's think about this. We know that we are getting $1,400 of cash in advance for work that we have yet to do. So we know cash is coming in, so we know we can debit that. So let's go ahead and debit that there. Cash. And that cash was $1,400. Now here's where we have to be careful. Again, we have not yet done the work. It specifically tells us up here in the problem that the services, the auto screening services, to be performed next month. So now, because they prepaid for those services, we owe $1,400 to them in services. So we have to credit a liability account called unearned revenue. Again, unearned revenue is any money that is paid to us in advance for services yet to be performed. Again, it is a liability account. Therefore, because it's a liability account, it will increase when we credit it. All right, we made it to the last one here on the 31st of December. It tells us here that Walton withdrew cash of $4,000. The owner of the business has a right to do that. Obviously, there needs to be $4,000 of cash in the business before they can take that out. So obviously, there was. So in this case, when we think of what accounts we're going to use, we know cash is exiting the business. We know cash will be a credit. But what will be our debit? Well, as a mechanism for any withdrawal, it doesn't matter if you're taking out cash, you could take out a computer, you could take out pretty much any asset, as long as you have that asset available to be removed, that you as the owner actually are entitled to it. So what we have is a mechanism called the owner's withdrawals account. So in this case, we will have to debit Walton withdrawals, and that was for $4,000. Again, remember, think back to assets. Withdrawals and expenses all have debit balances, so you can see part of AWE. The W is the withdrawals account, and we increase the withdrawals account by debiting it, so that's what we did. And then we're going to credit our cash account because cash is exiting the business. So that completes the steps 1 and 2 illustration here in this video. We've actually done all of these transactions. We recorded all of them in the general journal. And the next video will be step 3 of the accounting cycle, where we will take these journal entries right here that we did and post them into the general ledger T accounts.